Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. The S&P 500 is the 500 biggest companies in the United States. Recently I started looking at each sector within this ETF or within the S&P 500. So there are 11 different sectors. Okay, so we've got information technology. So far we've done a video on information technology where we looked at the 5 companies from that sector that are Sharia compliant and that could potentially be a good addition to your portfolios. We also have done another one for healthcare. Today we're focusing on financials. We've done one for consumers. We haven't touched communications yet, and I don't even think I will find that many companies within communication that are Sharia compliant, but I will do my research and I will let you know, inshallah. We've done industrials, we've done consumer staples. We haven't touched energy yet. Utilities will be very difficult to find any Sharia compliant company, but we'll do the same. Real estate will do the same as well. Although I've done recently a video on real estate, we could potentially find 5 companies within that sector that are Sharia compliant. And then we've also done materials. So we've got a few more of these videos to come, inshallah. If you like this type of content, please like the video, subscribe to the channel, and let me know if you have any questions. And like I said before, the reason I started looking at this is because when you're building your own portfolio, you want to have obviously you want to do Sharia compliant companies, but you also want to have diversified portfolio. And it's very important then to look at the best companies within each sector and pick the companies that fit, into your kind of time horizon, into your investment ethos and all of these things, right? So that's what I have been doing in the last basically 3 years now. Just picking stocks that I think are Sharia compliant, number one, and number two, that are, that I think will grow in their revenue, will pay me some dividends, will basically give me a total return that is better than basically buying in just one ETF and so on. Because remember, you're taking huge risk when you're buying actually individual stocks. Some people might just buy this one ETF that has about 200 stocks, okay, in it, with it, instead of buying basically 20 different companies, because the risk is very much reduced. So if one of these companies goes down in this ETF, you don't really lose much. So that's one of the benefits of having basically an ETF instead of stocks. But I do love picking stocks. Anyway, let's get to the news and what's happened today, because when the market opened today, this is what it looked like. So all of these companies, regardless of what sector, were up, apart from a couple of the healthcare companies. And there was a reason, because there was some news coming out of one of the companies, I think Merck and another company, I think it was Moderna, right? Apart from these companies, every single sector more or less was in the green. And not only just in the green, Apple was 3%, Microsoft was 3.5%, Google, for example, Amazon, Tesla, the big boys were up massively, right? And right now it's completely different. All of that is gone. Okay, and right now this is where we are. Okay, a lot of the companies have actually gone massively in the red. Tesla came back from being in the green to whatever 3% or whatever it was. Okay, 3% yet, to right now 5% down. Now all of that is happening because of this. Okay, the consumer price rose. Basically, the index actually was better than expected. They were expecting 7.3. Okay, but it was 7.1, and the index itself rose 0.1 instead of 0. They were expecting 0.3. Okay, and for that reason, inflation is basically heading downwards, which is quite nice to see, and is actually a very good news that it came down from, especially in the US. By the way, this is the US version. Okay, all-time highs basically from June. It was 9%. The all items, and right now we're looking about 7.1. So in a way, it's heading the right directions. What does this mean for investors? So the Fed will meet tomorrow. I think it's tomorrow or Thursday, and they will be increasing the interest rate, because remember, the ideal place for this thing to be is actually 2%. Remember that. The most important thing from all of this is ideally, okay, inflation should be about 2%, where it was When was the last time it was 2%? It was around February 2021. So almost about a year ago. That's when it was. So in order to bring it back to 2% from 7%, we have a long way to go. So the US government will then start increasing the interest rate tomorrow, but it's not going to be 0.75. It most likely will be 0.5. Okay, so 0.5% is the expectation. And then in February, I think again, they will basically reduce it maybe to 0.25. Okay, half it, and then maybe next time 0.25 until it comes back down to at least to just 2%. That is the target. The target is 2%. So we are way ahead of that. So people got too excited, bought so much stocks, whatever, and then people start selling it. And this is the thing I hate about the market. So this is why I don't actually bother looking at it each day, because it makes no sense. Because when the market opened today, my portfolio went from 61,100 to 62,000, almost to 500 pounds. Can you imagine? Right? And then it was basically came back down a little bit. Okay, still up, still a lot more higher than where it was this morning. Okay, but the point I'm trying to make is don't basically worry about the market. Don't worry about what's happening. Don't basically focus on the day-to-day fluctuation of prices and this of some of the stocks that you own. Okay, some companies will go up, some companies will go down. Yesterday Amgen actually went down quite a bit, just a little bit, because they decided to buy a new company. I'll talk about that more in the next video, but I'm not going to get into that, so we'll talk about more later. But yeah, that's where we are when it comes to inflation, and we will see where we are in the next few weeks. I mean, the UK is way worse than it. Basically, the US right now we're looking about what 10%, 11% in the UK. It's absolutely, we don't have a hope. I don't know what's going to happen. Okay, so here are the 5 companies that we're going to look at. So the first company we're looking at today is SPGI Global. Okay, you can pause the video if you want to see the whole thing in one go. Okay, I want to reduce the amount of time you guys are spending watching these videos, because obviously it's only 4 companies and it's easy to see it all in one go. So SPGI, basically it has a market cap of $113 billion. It has a wide economic price right now is $355 per share. Dividend yield just below 1%. Latest increase was basically 10%. 5-year growth rate of 16%. Payout ratio 28%. And it has increased that dividend 48 years in a row. Safety 99%, which is absolutely perfect. Profit margin is really nice. Return on equity is good. Free cash flow here we're looking at about 2.3, which is really nice. Total return of almost basically 21% on the last 10 years. And next year they're expecting the earnings to grow about 13%, and then basically every year after that is basically we're expecting about 8% growth on average, basically. Okay, right now according to Morningstar is fairly valued, and is actually discounted by 6%. It's probably gone up quite a bit today. In fact, let's actually have a quick look. Yeah, 2 something percent up actually today, and it currently is trading $355 per share. What they're expecting is the fair value basically for them is $370 per share. Moody's is the next company. Okay, this company is also very similar. They both basically, these 2 companies, all of these companies, in fact every single one of them, although they're in the financial sector, they don't actually deal with interest or anything like that. They actually credit rating companies, so they rate other companies' debt levels, countries. They actually deal with specific companies, if you specific countries, and so on. So they are the credit side of it rather than dealing with the bank side of it. Okay, Moody's is very similar to this company. Okay, there's not much difference in terms of things that they do. It has also wide economic moat. $299 per share. Dividends are almost identical. Latest basically increase was 13%, 11% 5-year growth rate. Payout ratio 29%, so very similar, but they have not been increasing their dividend as consistent as the as SPGI, S&P Global, right? So 12 years of increasing that dividend, 83% safety, 27% in terms of their profit margin, and return on equity is 64%. Free cash flow, looking at $1.1 billion, okay, and then the total return in the last 10 years, we're looking at about 20%. So very, very similar in terms of where they're heading. Next year, expectations similar, but the next 5 years they're expecting the earnings to slow down, which according to Yahoo Finance. So this is why you always have to look at these analysts and say, okay, where are they getting that data from? Okay, and you have to be careful. Okay, so that might happen or might not happen. So that if you're a long-term investor, that shouldn't stop you in investing in a company like this. Okay, fair value right now, $290 per share. That's where it almost is. And the next one is MSCI. Again, is one of the credit rating. They have a lot of ETFs, a lot of indexes, and so on. Only 39 billion, so almost just about 40 billion market cap. As you can see here, the biggest one here is basically S&P Global, and then you've got Moody's, then you've got this, and then you've got this, okay? And then it has what economic mode, $500 per share right now as we speak, 1% dividend yield, so they are very low as well. 20% of, they recently increased their dividend by 20%, 29% 5-year growth rate, payout ratio almost 40%, 7 years of increase in that dividend. Safety is only 61%. That's basically anything below that is a bit of a risky, but anything above that is fine. 6-1 and above is absolutely fine. Profit margin is very similar to the rest of these companies. Return on equity, something is going on there. There might be negative negative shareholder equity going on there. We'll double check that. Free cash flow, basically we just got less than $1 billion. Total return in the last 10 years is about 33%. Next year 10% growth or 11% growth, and then 13% every single year after that. 34% premium right now. $370 per share is where it should be right now. Is $506 per share. The next one is FactSet Research Systems, $13.1 billion. It has a narrow economic mode, $450 per share. Each one of these companies seem expensive when you look at their prices, but they don't pay any dividends. Okay, I don't know actually what happened to the dividends. Wait, hold on a second. No, I lied. They do pay dividend. Okay, I think the formula, something happened to the formula there. Again, very similar to the rest of these companies, less than 1%. Latest increase was 9%. 5-year growth rate of 10%, payout ratio 26%, and then they have increased this dividend 23 years. So soon this company will become a dividend aristocrat, which is a company that has increased its dividend for 25 years in a row. Safety at 95%, profit margin, and I'm not sure what happened. I think something happened to the formula. I need to double check that. And then they've got about $500 million in the bank right now to actually pay to cover this dividend that they paid. Total return in the last 10 years, we're looking at about 17.5%. Basically next year they're expecting about 11% growth, and then every single year 12% for the next 5 years. 23% premium right now, $365 per share is actually where it is. Every single one of these companies is actually Sharia compliant, so I've checked with Zoya and I've checked their market cap and so on, so they're absolutely fine. Quickly show you some of the things. So S&P and Global, when you look at the total revenue for the basically in the last since 2012, so from $4 billion to right now $10 billion, that is heading the right direction, absolutely. Okay, and a couple of other things I want to show you is free cash price to free cash flow for this company currently is 43, right? 43. But on average, it's supposed to be 27. So for some reason, that if you look at that, that kind of tells me it is actually a little bit premium right now. But obviously, because of the growth and everything else that company does, and the fact that they actually are very stable business, okay, very predictable income, that's probably why people are paying a little bit more for this company. And the next one I want to show you is Moody's. So again, the same thing when it comes to the total revenue from $2 billion to right now $5 billion. So that's also heading in the right directions. And when it comes to the price to free cash flow here, we're looking at 47 to right now 32, and then on the index itself is about 32. So it's slightly cheaper, slightly more expensive than the index right now. So that's the second one. And then the third, MSCI, is exactly the same when it comes to revenue. So if you from 8 million to right now $2 billion, which is heading the right direction. So the revenue is growing, which is very good. Also, the net income is heading the right directions, which is absolutely brilliant to see, right? And then when you look at the price to free cash flow, again, these companies are very, very similar. I'm not sure what's going on, but they all seem to be in the 40s when it comes in the 5-year average. This one is actually trading 38, so it's quite expensive. Always been an expensive stock if you think about it. And then finally, the final company we're looking at the FDS, and that when it comes to revenue, okay, from about 8 million to right now 1.8 billion, which is really good as well. And then when you look at their net income for that as well, so that the money they take home after all of that, from 200 million to right now about almost to 400, so that's actually doubling, right? And then price to free cash flow, again 35 currently, and when you look at the 5-year average is about 28, so it's slightly cheaper in comparison to some of the ones that we've seen so far. But yeah, there you have it. There's 4 different companies that you could potentially look into. I'm not saying you have to buy them right now, but look into it, do a bit more research and find out exactly what the companies do, a bit more detailed. But they all seem really good companies. For me, this is the one I own in my portfolio. I'm considering, okay, adding this because of the predictability in terms of their revenue and so on, but because they are very similar, I'm not sure. I'm gonna do another video on just dig deeper basically into this one here, or maybe even this one. I'm not sure. We'll see what happens. But yeah, let me just quickly show you, just for transparency. I've got 4 shares of this company, £1,152 right now. I'm up about 6%. Recently I was down. I would like to actually add more of this company, but it needs to come back down a little bit for me to actually even look at it again. So recently I said to you guys, I have been buying 1 share of Unilever every single week. I missed the last week and I'm almost missing this week, so I am going to buy 2 shares. So right now, as you can see here, I've got £180, and a lot of that, believe me or not, came from dividends. So I'm gonna actually be doing a video as soon as December is over, I guess. But yeah, the dividends has been so far absolutely amazing. So I think I have got the highest amount of dividends just today, which is absolutely brilliant. So what I'm going to do now is I'm going to buy 2 shares. The markets, UK markets is close to right now. So I'm going to buy 2 shares of Unilever for last week and this week. Okay. Although it's up a little bit for the, okay, as you can see here, I'm up only £11. So it's not really a lot. So I will probably be averaging it up instead of averaging down, but that doesn't make any difference to me because I do like the business and I am buying 1 share of this business every single week. I hope you enjoyed the video. If you have, please like the video, subscribe to the channel. Have a wonderful day. Assalamu Alaikum.